And the big game afoot is that we're at the end of a 100-year banking system that started in 1913 with the Federal Reserve. This is about the military industrial complexes around the globe wanting to hold on to power and their printing machines. And everything you see is literally an attempt to keep the system going. It needs ever increasing amounts of debt and expansion and new excuses to put everybody in fear. So division and hatred are actually part of the game, and they're trying to stoke it on purpose because there's a meme that's been going around for years that shows a king on a parapet, and down below are the peasants with their pitchfork and torches. The advisor leans over and says, "You don't need to fight these people. All you need to do is convince the pitchfork people that the torch people want their pitchforks." And that's just, that goes back to ancient Babylonian times. That's how you control the masses.
Well, to that point, I'm happy you brought that up because you've been saying, since I've known you, Edward, that this is the global sovereign debt bubble, the everything bubble. And you point to what just happened in Japan, which took a lot of us by surprise. And now you say that the clock has been set for the global unwinding of the debt, and it's going to be in conjunction with a weakening U.S. economy. I'm predicting it's just the clock getting started. So let's get your thesis here as you see this global unwinding of debt happening.
Yeah, so the global debt bubble has been building for 14 years. You got to go back a little bit. So the Fed system, lowers interest rates, creates a bubble. The bubble, they don't actually control where the money goes, and there's a bubble that's created, and the bubble usually ends when they raise interest rates, take away the punch bowl, then some fraud somewhere is exposed. In the 90s, it was the dot-com frauds, corporate fraud with Enron and WorldCom and other companies that just disappeared overnight, went bankrupt. Then they had to blow another bubble to save the economy again, and that was a real estate bubble that ended up on the bank's balance sheets, and that was just fraud everywhere. And not one banker went to jail, I remind you. Then to solve that debt problem, they needed to create more debt. The system needs constant debt creation because money printing is actually debt creation. So they printed more money, created more deficits, and for 14 years, we had basically zero interest rates. And it was going to pop at some point, but because it had gone to the fraud had rolled onto the central bank balance sheets, because remember, they bought all the fraudulent bonds to save the system, and the government spent like drunken sailors. The fraud rolled into politicians and central bankers. So here we are, and it was going to manifest eventually in the foreign currency markets, because eventually the release valve is FX, and that began in Japan. Japan kept their interest rates at zero as the Fed was raising interest rates to 5.5%. By the way, that's the fastest rate of change increase we've ever seen in the history of the Fed. It went from 0 to 5.5. So the money supply started coming down, and Japan got into a bit of a currency crisis. And not that long ago, Japan, the US dollar JPY pairing trade went to 160, which was the levels we hadn't seen since the 90s. So Japan was in the midst of a currency crisis. Their debt to GDP is 290%, I think, versus our 120%. So they had to defend their currency, and they raised interest rates 25 basis points in August. And we saw what happened. The Nikkei crashed, and the U.S. stocks followed. That was the beginning. That's the clock starting. It's gonna, it doesn't happen overnight. There was a lot of coordination between the Fed and the Bank of Japan. Right. And they're basically trying to hold it together. And since the markets swooning in August, the JPY US dollar pair trade has gone from 160 to 139 last night. So the Japanese yen is strengthening as the yen carry trade is unwinding. And the yen carry trade is a trade that's been going on for decades. People borrow in yen because interest rates are zero, and they lever that up and buy foreign assets. So the problem is Japan is caught between a rock and a hard place. Save their currency or unwind the yen carry trade globally. And I suspect they're getting pressure from the U.S. government and the Fed, and they're caught between a rock and a hard place. So that's the clock starting. And we also, in conjunction, have a weakening U.S. economy that we were predicting a recession in the second half of 23.
Right.
That didn't happen primarily because of unprecedented government spending, government job creation, illegal immigration added to the GDP. But that juice peaked in March, according to our early cycle indicators, and we never went above. We have a metric. It's, above zero is expansion. We got right below zero, and then we rolled over. So our economic cycle indicators have been rolling over since March, and we believe it's going to pick up speed. We have an election where every business right now is paused. I'm hearing from everybody that no one's spending any money. Large projects are not going to happen until after the election. So we're in a dangerous time. The Federal Reserve is set to cut interest rates 50 basis points, 25 to 50 basis points this Wednesday. And typically speaking, everyone thinks that's a bullish thing for the markets. But if you look back at other economic downturns, the beginning of the Fed cut cycle is the beginning of the pain. So the pain is ahead. And when they cut, if they cut on Wednesday, it's going to trigger, I think, a massive reallocation out of stocks into bonds, because bond people know now that the Fed is in a cutting regime, and they'll sell stocks to buy bonds.
Yeah, and we are speaking before that decision. Do you feel they felt pressured to do the decision before the election because if they waited after the election, it would look fishy? I mean, why not just wait until after the election?
Well, the problem is there's lots of indications that there's financial stress globally, and the Wall Street banks and anybody that's involved in leverage is clamoring for interest rate cuts. So, in a very perverse way, the interest rate cuts themselves will trigger the financial crisis even more, but it's also needed to keep a lot of these entities afloat. Right now, they're putting fingers in dikes. They're supporting the Federal Reserve directly supporting Japanese banks.
I want to get back to your recession indicator. So where are you, just to be clear, where are you at now with that? I mean, now the yield curve no longer signaling a recession. Do we breathe a sigh of relief here?
No, so the yield curve, this is actually when it begins. When the yield curve inverts and then steepens, that's the beginning. Yeah. So, because the bond markets are anticipating lower interest rates. So the bond markets, the Fed, bankers are clamoring for lower interest rates because we have credit problems throughout the globe that are being hidden, not talked about in the financial press. The system is very precarious right now, and everybody in the halls of power know it. And the financial markets and the public at large will start to figure it out. The biggest tell for me is Warren Buffett. Warren Buffett has basically gotten out of most of his stock positions, accumulated his largest pile of cash. And where is he sitting? He's sitting in T-bills. He's earning 5% to wait. He owns 4% of the T-bill market, which is more than the Federal Reserve. This guy knows what he's doing, and he's waiting. He's not looking for a 10, 20% correction. He's looking for 50, 60% correction. And then he's going to come in and buy on the cheap like he did in the great financial crisis. He was in cash before the great financial crisis as well.
You brought up Warren Buffett. What did you make of his call to pull out from Bank of America, a part of his position? I mean, he still owns a position, but a big chunk of it.
I haven't done the work on Bank of America, but I rely on people on Twitter that are great analysts that I follow. And they have been highlighting balance sheet issues in these banks for the better part of 6 months. And we have to remember, we had bank failures in March of 2023 that happened super fast, and there was panic. And the Federal Reserve did what was called the Bank Term Funding Program, where they gave loans against underwater bonds. Now, the bonds that were underwater then were due to interest rate duration risk. These were safe securities that had gone down 30% in value because of just interest rates going up. what the Federal Reserve is not going to do, lend money against is bad credit. So these banks have commercial real estate loans, bad credit on their books. The Fed is not going to bail them out of bad credit. They bail them out of duration risk, interest rate risk, but not, it will not give money for bad credit.